Hello, everyone, and thanks for logging in to take a look at what we believe is the most exciting opportunity in the country right now in Pivotal Wealth. And my name is Jason Brown. I'm one of the founders of Pivotal Wealth. The person who sent you to this video or this webinar probably told you a little bit about our company, and our goal is to change the financial situation of as many people as possible. And we believe the way to do that is simply by two things, right? If you really want to improve the financial situation of not just a family, but anything really, like a business or a church or a nonprofit, and again, certainly the family, it consists of two things: get out of debt, reduce debt, and increase income. Right? It's not rocket science, right? Lower the money going out, increase the money coming in. And so that's really what our platform is at Pivotal Wealth. We have the top debt reduction and debt resolution platform in the country, and we have an incredible way for people to increase their income from home without having to sell anything, without having to join a company, to be on the phones, or, to truly create income that's independent of anything outside your doors. So, and again, to accomplish these things, we've formed some incredible strategic partnerships with companies that have proven track records, and everything from phenomenal ratings with the Better Business Bureau to every forum that's out there that talks about people that have had experiences with these companies. And so, when we're looking at affecting as many lives as possible, we want to do it with companies that have the same standards and goals that we do. And so what we're going to talk about in this presentation is debt, right? Helping people get out of debt. And, when we talk about debt, there's really two types of debt in our country. There's secured debt, which is backed by collateral, right? That's like a mortgage or an auto loan. The lender's typically not willing to do a whole lot to help you in this, because if you default on the loan, what do they get? Well, they get the asset, right? Now, there used to be loan modifications back in the day. You don't hear much of those anymore, or people can refinance to a lower interest rate. But for the most part, there's not a lot of forgiveness or resolution programs out there. There's programs out there that will help you pay it off early, of course, by sending in extra money. But truth be known, guys, you don't hear a lot of people declaring bankruptcy over secured debt, right? The people that have really gotten in trouble, it's typically over unsecured debt. That's your credit cards, student loans, hospital bills, again, medical debt, business debt, lines of credit, loans that are not backed by an asset, right? They're basically just backed by your credit. And of course, the majority of programs out there today, that's what they focus on, is unsecured debt, and Pivotal Wealth and Empowering America are no different. When we talk about debt, and I don't want to spend a ton of time on this, because if you have some debt, you probably already know what it's like to feel the stress of debt. And I've seen it firsthand in people I know and my family growing up. Health issues. One of the leading causes of divorce is finances, which again, typically debt. And, other important things that debt keeps you from doing. Number one, saving money for later in life. Can't protect your family with an adequate amount of life insurance because you can't afford the premium because you're servicing debt, right? A good friend of mine's in the mortgage business, and every day he has to turn people down. They can't qualify for a loan because of something called DTI, debt to income ratio. It isn't an income problem. They make good money, but they have too much debt. And so, just this high interest unsecured debt, bottom line is it just greatly restricts quality of life. And I'm not trying to just drive a wedge in even further to increase the bleeding, but I just want you to understand kind of where we're at in our country. I think people have just kind of over the last few years focused more on a monthly payment that they can afford rather than a balance, right? People are comfortable carrying a balance now. And everything you're buying, anything from furniture to you name it, they just keep extending out terms, knowing people are probably never going to pay off those balances. They're just trying to get a monthly payment down low enough that people can afford it and they're comfortable, and then that's how they accumulate more and more debt, right? You know, for the first time in our country's history, a little over a year ago, January 1st, 2019, we surpassed $1 trillion in credit card debt. Now, guys, when we factor in all the other unsecured debt like student loans and medical debt and gas cards and everything else, lines of credit, it's multi-trillion. But if you just take credit cards, we just surpassed $1 trillion. And guys, what do you think's happening to the debt level in our country right now? With everything that's going on, people's ability to earn money has been affected. Having to decide which payments they're going to make, living off credit cards. Again, if you're in a position where you've accumulated some debt, you're for sure not alone. And there's a lot of programs out there. Again, there's probably never been a time, well, for sure in our lifetime, but maybe in our country's history where people are accumulating as much debt as they are right now. So let's talk about the programs out there. You know, there's a lot of programs that offer plans, right? Like debt roll downs, or, you know, where you pay off the highest interest first, and then the money that you freed up, you roll to the next one and to the next one, and credit counseling, things like that. Look, a lot of those, do they work? Absolutely. But sometimes they're just not fast enough, right? Look, don't tell me rather than pay my credit cards off in 20, I'm going to have to get them paid off in 11. Is that good? Well, yeah, 9 years savings, but is 11 fast enough? No. And guys, if it is for you, great. Maybe that program would be for you, but I think most people, they want to be able to hit a reset button. I think most people say, hey, listen, you know, I got in trouble, and maybe it was my fault, right? Maybe it was my fault. Maybe I made some bad decisions along the way and I was irresponsible, or maybe it wasn't your fault. Maybe loss of a job, maybe unexpected medical expenses. Maybe there was a worldwide pandemic, right, that affected your ability to earn income. And so that's what the platform at Empowering America provides, and why we're so excited to be marketing it for them, you know, through Pivotal Wealth, is reduce the balance roughly half. Day one, balance reduction. Well, guess what that does to the monthly payment? It typically reduces that monthly payment less than half. And guys, maybe the most important thing, eliminate future interest. So I'm going to show you this platform. And again, you may have to watch this presentation one more time to really get your mind wrapped around it. And then you'll want to get with a representative from Empowering America, and they'll see which program you qualify for. And of course, there's never an obligation to do these. You can at least see what the options are. So one of the things that makes this platform a little different than most companies in the debt space is most companies offer one solution to resolve your debt. You know, if somebody runs a debt consolidation company, well, guess what they're going to try and talk to you into? Consolidating your debt. And that's all they do, no matter the situation. If somebody runs a debt settlement company, no matter what, they're going to try and talk to you about debt settlement. Well, guys, Empowering America platform has multiple strategies on it. And so what they do is look at each one of your debts and say, hey, which strategy is going to save you the most money and have you out of debt the quickest? And so what I'm going to do is I'm going to take the next few minutes and show you each one of these strategies. It'll just spend a couple minutes on each. But the best way to describe it is kind of like a sifter or a shaker system, right? The first level of or the first strategy is the first sifter, and what debt we can fit into that strategy, and it's the most effective strategy for that debt, that's what gets applied. But what doesn't, we don't try and fit a square peg in a round hole, right? It's going to fall to the next strategy. and we're going to apply that strategy because it's going to save the client more money or be a better fit. But what doesn't fit there, it'll fall to the third strategy, and so on. So hopefully you get the point. So that first level, this strategy is called debt assumption. Now, guys, I've been working in the debt space for almost 15 years. I thought I'd known every strategy and concept there was in the debt space, and until this was presented to me about a year and a half, almost 2 years ago. And I'll be honest with you, my jaw was on the floor after I saw this. It was mind blowing, and so I said, look, this concept needs to be, presented to the public in a huge way, because first of all, it rights basically what I feel an injustice. It evens the playing field between credit card companies, the banks, and consumers, and it kind of tips the scale where now we're playing by the same rules. So debt assumption involves contract law, and you don't have to be an attorney to understand what a contract is, but I did look it up in the dictionary, and it says it's an agreement between private parties creating mutual obligations enforceable by law. So if you and I have a contract with each other, everything in there is enforceable by law. And it's not just reciprocal. We're both obligated, right? Neither one of us can change the agreement without the other one agreeing. So you can propose changes to me, and if I accept them, they're part of the contract now. But if I decline those changes, it stays the same. But they're reciprocal. I can propose changes back to you. If you accept them, they're part of the contract. But if you decline them, then the contract stays the same. Probably haven't taught you anything yet, but what you did not know, probably, if you're like me, is that the contract that you carry with your credit card and many of your unsecured lenders, they renegotiate those contracts typically on an annual basis, sometimes more often than not. So for example, let's say that you have a credit card and you're at 3.9% interest rate, okay? And the credit card company says, hey, listen, Mr. and Mrs. Jones, we want to change the contract. We want to change your interest rate from 3.9 to 19.9 or maybe 29.9. Okay, well, what are you going to say? No, right? You're going to say, no, I'm good with the contract the way it is, 3.9. They're going to say, hey, we want to talk about a finance charge or a different fee structure. And you're going to say, no, I don't want to do that because they can't just change it. Well, guess what? You agree to it every year. How? By simply swiping the card. They send you new terms in the mail, like a new interest rate or a new fee structure, a new finance charge, and you don't even know it, and you swiped your card. What did you instantly do? You just agreed to all those new terms. Now, guys, when this was presented to me, I believed it because it makes sense. But at the same time, I'm like, you've got to be kidding me. Really? All these years, every time you swipe your card, you're agreeing to new contract terms. Well, one of our colleagues actually brought in a Visa statement, a letter that he had got from his Visa, his credit card. And it was 3 pages long, a .00 font, right? You wouldn't read it. In fact, you wouldn't even read this whole paragraph. But I'm going to highlight a little bit. It says, change in the terms of the agreement. We can change the terms of this agreement and disclosure statement at any time. If we do so, we will mail or deliver you a copy of these changes. We may give you a written notice of the changes in terms by printing it on your monthly statement, including it with your monthly statement, or by sending you a separate notice. So here's what they're saying, guys. We're going to make changes to this contract, okay, to this agreement. We will deliver these, or we will send it to you in the mail. Now look down about 3/4 of the way down. Any such change which involves an increase in the finance charge or imposition or increase of any other fee or charge will not apply to your account unless you, including any authorized user, use the card after the effective date of the change. So again, what are we saying here? They're going to send us changes. Anything that involves a fee or a charge is not going to apply to our account unless we use the card. Now, this next sentence is just a kind of a kick below the waist, right? It says, if you do not wish to to accept the change, you may return all cards to us cut in half and then continue to pay the balance on your account. So basically they're saying, we're going to play by the golden rule and we have the gold, right? So you have to obey the rule. Well, guys, do you remember when we talked about contracts? They're reciprocal. We can actually do the same thing back. Now, this is where it gets interesting. Guys, about 15 years ago, a group of attorneys started a proprietary program called debt assumption, where they actually assume your debt by becoming a co-debtor. So what's that mean in layman's terms? They actually go on the debt with you. Their name's going to go on it. They're going to take all phone calls on your behalf. They're going to make the payments on your behalf. They basically take it over. Now that gives them limited power of attorney, so they're going to create new contract terms and conditions with the creditor, just like they've been doing with you for years. Now look, it's proprietary. They don't raise the curtain and show you exactly how they get the new terms negotiated and accepted. But in 15 years of business, they've never had the submissions to the creditors get rejected. So again, what's that mean in layman's terms? They renegotiate the terms of your contract with the credit card company, just like they've been doing with you for years. Now guys, basically, again, without going into too much detail, they're now making payments on your behalf. They're going to send in new terms, new changes, proposals to the contract with a payment. Well, guess what happens as soon as the bank cashes that payment? They just accepted those new terms. Now, guys, it's nothing crazy or unethical, but there's about 10 to 12 new terms that they get accepted. I'll tell you 3 of them. Number 1, 0% interest rate. Hey, moving forward, our interest rate, 0%. Number 2, no late fees. We're going to pay you every month, but you can't charge a late fee. Number 3, no negative credit reporting. Our business is between us. We don't need to involve a third party. So as soon as the bank cashes that payment, they agree to those terms. Now, guys, when I saw this the first time, I said, well, wouldn't the bank just not cash the payment? Listen, Bank of America processes 60 million payments a month. It's not a manual process, right? It's automated. You don't have somebody manually taking these payments, making sure that there's no contract terms or contract proposals attached to the payment, and then cash it, right? It flies under the radar, just like when you swiped your card. That was under the radar, right? We're just literally playing the exact same game. Well, they didn't realize, they said your new interest rate is 0 and that they're going to continue to charge you interest. So they're breaking the contract. We're going to charge them a fee. If we send in a payment late, they're going to charge you a late fee. Well, that's in violation of contract. We're going to charge them a fee. They're going to send something negative to the credit saying you were late. They can't do that. That's in violation of new contract. We're going to charge them a fee. So as the creditor breaks the terms of the new contract, fees are assessed. So just like when you broke the terms of the old contract, like make a late payment, they charge you a fee. Now, guys, here's the jaw-dropping part. On average, within 10 to 12 months, the amount you owed is offset by the fees assessed under the new contract. So for example, you owe them $3,000 on a credit card. They've racked up fees. They now owe you $3,000, and the debt is offset on both sides for a 0 balance. It's a wash. So what do you need to do to get this set up? It's a one-time activation charge of $250 and $100 per account. So if somebody has 4 accounts, it would be $400 plus the $250. That's your first monthly payment. And then you're going to pay 45% of your original debt amount to the debt assumption program. So again, for example, their average client over the past 15 years has about $40,000 in unsecured debt. They're going to get that debt offset, and the client is going to pay $18,000, which is 45% to the debt assumption program. And you're going to pay that over 36 months at zero interest, and then you're done. Now, guys, if you took 18,000 and divided by 36 months, it would be 500 even. There's a $59.99 maintenance fee, which I'll show you what that goes to in a second. So your new monthly payment, instead of paying $1,200 a month, which is 3% of the balance every month, you're going to pay $560, and you're done in 36 months. So let's kind of compare apples to apples here. Guys, I just went on bankrate.com. They have a great credit card calculator there. I just literally copied and pasted this or screenshotted it and put it onto this presentation. Just go type in an amount. I typed in 40,000. I tried to be conservative. Most people's interest rate is higher than 15. Their monthly payment, I said, is usually about 3% of the monthly balance, or of the total balance. So it'd be $1,200 a month. Of course, as that balance goes down, that payment would go down. But they're going to pay $28,000 in interest for a total of $68,365. And it would take 291 months to pay off. Guys, do you realize that's 24 years, 3 months? There's another word for that. Never, right? Now let's compare it to if we put that exact same debt onto the debt assumption strategy. That 40,000, they're going to pay 45% of it now, which is 18,000. Guys, what's crazy? Interest paid over here is 28. They're going to only pay 18 over here. So literally $10,000 less than what you were just going to pay in interest on scenario one. There's a $59 a month maintenance fee. Now that goes to cover a couple of things, but one is the client actually gets a back office portal. So you get to see exactly what's going on with each debt. You'll get to see new contract terms submitted, new contract terms accepted, fees being accrued. If you get anything in the mail, you load it into your back office portal, so you know what's going on. So that covers that, in addition to a few other things I'll explain in a minute. But you're going to do that for 36 months. So the new monthly payment is $559.99. I'm going to say for this example that we had 6 debts. So it'd be $100 per account plus the $250 activation. So month one, instead of paying $1,200, you'd pay $850. So save about $350 that first month, but then the next 36 months, your payment is $559.99. That's a savings of over $600 per month. A couple more just parameters on debt assumption, and then I'll move to the next strategy. Again, average client is over the past decade and a half spent $40,000 in debt. The minimum combined debt is $15,000. So to go into debt assumption, you have to have at least $15,000. If you have less than that, you'll just go to the next strategy I'm going to show you. But you can go all the way up to $500,000. You do have to have at least 2 debts. Okay, so it has to be combined amount of 15. One could be 13,000, the other one 2,000, but they have to add up to at least 15. The maximum for one account is 24.5. Credit repair is included at no additional cost. So part of that $59 a month also goes to cover credit repair. So that question comes up a lot, and that's probably a question that you have in watching this presentation is this going to affect my credit? Guys, the answer is not it might or, maybe. No, the answer is absolutely. It will affect your credit, and you need to know that going in. We're very upfront about it. What we have found, though, is most people's credit's already being affected because of the balances they carry, or maybe they're struggling making their payment, or people are willing to take a hit on their credit for 36 months to get rid of this debt altogether. So, but listen, if you're in a position where you are going to be buying a home or using your credit in the next 2 to 3 years, or if you just keep your credit score right up there with your faith in your family, then you should not do this. In fact, you really shouldn't do any debt resolution program because they all affect your credit. So definitely something to consider when you're making the decision to move forward with this. But it's 100% money back service guarantee. They've never had to use it actually, but if for whatever reason they're unable to get those contract terms renegotiated, then they refund any monies you paid in. So guys, what else in debt assumption? Nothing federal, okay? No back taxes, no IRS debt, no federal student loans. Private student loans fit into debt assumption. Almost all credit cards, lines of credit, unsecured business debt, signature loans, things like that. But what doesn't fit in, there are some credit cards that don't fit, debts that don't fit in these parameters. If you have a debt higher than 24.5 or you don't quite add up to 15, or some debts are structured to where the debt assumption program doesn't work, they will fall to the next strategy, which is debt settlement. If you're familiar with debt settlement, it's been around a long time. We've partnered with, industry leader Alleviate Financial. They're phenomenal at debt settlement. They've been doing it a long time, A+ rating with the BBB, which is extremely rare in the debt space. But how debt settlement works is they actually just start a savings plan with you. And your new monthly payment is typically close to 50% of your current payment. And then when enough money is saved in that savings plan and that account, they negotiate a lesser payoff with the bank, with the credit card company. So it's pretty similar, as far as at the top, it says different programs, similar result. As far as the client goes, it's almost the same because your new monthly payment is about half of what it was, and you're going to pay it for 24 to 48 months, and then you're done. No interest, it's over, okay? So even though it's different than debt assumption, as far as the client is concerned, if that's you, you're going to your new payment's about half of what it was, and you're going to pay it for roughly 36 months. So it's about the same. So let's compare those two the debt settlement with your current situation. If you had $40,000 of credit card debt at 15%, again, you're going to pay $68,000 back over 24 years and 3 months. If that debt doesn't fit in debt assumption and it goes to debt settlement, they typically settle that for 65%. So now you're going to pay $26,000. Now look, I realize it's not 18 like the other plan, but let me ask you, what would you rather pay? $68,000 or $26,000? You're still paying less than what you were just paying in interest on your current plan. We can stretch those payments out as far as 48 months if we need to get that lower monthly payment. So in this scenario here, the monthly payment is $541. So even a little lower payment than what we had in debt assumption. Of course, you're doing it for 48 months. However, there is zero down payment. So if the debt settlement strategy gets applied, there's zero upfront cost. And again, we could enroll those same 6 debts or more or less. So here we're saving, we're paying $1,200 a month. We're freeing up about $659 here on a monthly basis. What could you do with that extra $600? Gosh, maybe put some towards a retirement or a savings plan or life insurance policy, and maybe put $200 or $300 back in your pocket, right? Other debt relief options. So the majority of the time, one of those two strategies is a good fit. But we also have debt validation. So if somebody is maybe a little further along, if you've already maybe stopped making payments, you haven't declared bankruptcy, but it's maybe heading that way, your debts are in multiple layers of collections, right? Debt validation is usually a great strategy. What they do is they just go in and audit each debt. They make sure that the collections agencies are obeying all the rules and laws that are set up to protect you as a consumer. They have to provide the correct documentation showing that that debt is valid and that they have the right to collect it. Because what happens a lot of times, those collections agencies buy that debt at pennies on the dollar, and then they do any means necessary to make your life miserable to try and collect. And they just can't do that, folks. So many times that debt becomes invalid or uncollectible. We also have tax assistance. There's so many people in our country who have tax issues, and maybe it's something as small as maybe a misfiled tax return or didn't file a tax return for 1 year or a few years, all the way up to a huge balance that they're paying an installment agreement on. And so our tax assistant program is again, second to none. So guys, if you're taking notes, you want to write down this acronym, VAST, V like Victor, A, S like Sam, T like Tom. So that's actually our debt platform. V stands for validation, A stands for assumption, S stands for settlement, and T stands for tax. So just kind of reviewing the 4 strategies there. Now that's not the order of the SIFTR system that I told you about. First one is assumption, then settlement, then validation, then tax, but that at least help you remember exactly what they are. We do have federal student loan relief program as well. These are federal student loan programs. And so they're designed for folks that are state or federal employees, city employees, municipality workers, policemen, firemen, teachers, and in many cases, there's loan forgiveness there. So guys, just to kind of wrap up, what did we just do? Day 1, year 1, month 1, reduce the debt by 50%, free up hundreds of dollars in monthly monthly payments, and now we're on track to be debt-free, typically in 36 months. A question comes up that says, can we pay it off early? Absolutely. You can, until you can take that extra money that you freed up and put it towards that lower amount. But even if you didn't, by year 3, we're now debt-free, right? And now the rest of that money is freed up. So guys, I want to end by showing you one more thing. If you hop over to our website, which is pivotalwealth.com, right here is a debt calculator. You can come right up here, click on it, and of course it talks a little bit about debt, and it's just going to say, okay, how many accounts do you have? Well, let's say we have 5, okay? We'll go to the next one. How much do you still owe on your account? So how much do those 5 accounts add up to? I don't know, let's say they add up to $37,500. And we're going to submit. Guys, it takes literally 1 second, right? It says, okay, here's your current plan. 5 accounts, 37.5. We're trying to compare apples to apples here, right? That says if you're going to be paid off in 36 months and your interest rate is 12%, again, being conservative, your monthly payment would be $1,246. So that would be the payment. Now, your minimum monthly payment might be a little less than that, maybe around $1,000 or $1,100. But if we're going to get you out of debt in 36 months, you're going to make 36 months of $1,246, so you would pay $44,000. On our plan, if it goes into debt assumption, which the majority of times it does, you'd pay a $250 upfront fee plus $100 per account. So month 1, you're going to pay $750. But then for 36 months, your new payment is $528. Your total principal you're going to pay is $16,875. So guys, if we look at the savings, we just saved $28,000 and $717.84 a month. So guys, thank you for logging in and watching this presentation. This is, Pivotal Wealth. We're so excited to have partnered with Empowering America to put the best debt platform in the country out to the public and literally to show people that when you have debt and you're struggling and it's causing this stress and fracturing family ties and worsening health and everything else, that you actually have some options out there. And I'm not telling you that it's going to be all sunshine and roses when you're going through it, okay? In that first 12 months, 24 months, the banks are trying to get that money, but at the same time, you know that Pivotal Wealth and Empowering America have your back. And that's why these plans are in place, is to help people in a position where they're just never going to get out of debt. Truth is, you're never going to pay that $37,500 off, right? If you're making the minimum monthly payment, you're paying the $1,000 or $1,100 a month, it's going to take you 24 years. You would just never do it. So guys, get with the person who sent you this webinar. Let them know your level of interest. They'll put you on the phone with a qualifying specialist from Empowering America who will look at your debts and see which debt would make the most, or excuse me, which strategy would make the most sense. They'll show you exactly your numbers, how much your new balance would be, how much your new payment would be, and then you can make a decision whether it would be a good fit for you. So again, have a great day, everybody. Thank you so much for your time.